Hello, everybody. This is Noah and John, and we are from UrbanDigs, and this is Talking Manhattan, Johnny. And this is going to be a special commercial sector edition. And I'm very proud to invite James Nelson, Johnny, Principal and Head of Tri-State Investment Sales over at Avison Young. And we're going to get a nice glimpse into a sector, a commercial sector that we never talk about. And we've always said to our audience is that commercial sector is one of those tentacles of the beast, of the product beast of our market that's, not got it really hit in the pandemic. And is it coming back? Is it fully online? Is it getting there? Well, this is the kind of questions we're going to answer today, Johnny.
Looking forward to it.
Yeah, me too. All right, James, thank you so much for coming in here today and spending time with us today. And let's just start out right off the bat. Do me a favor, if you can give my audience an update on what is the state of the investment sales market, specifically now that we have rising inflation and we have interest rates that are potentially affecting your pricing and activity.
Well, first of all, I want to say thank you so much for having me on the show. I'm a big fan, and look, I've learned so much from you all. And I think to be a great commercial broker, you need to know what's going on in the residential space. And I'd like to make the case today for your listeners that to be a great residential broker, you also need to understand what's going on in the commercial world. So really excited to have this conversation. I love talking Manhattan. So yes, we, and this is hot off the press. We just put out our second quarter numbers. And so, the question about price, it's a little too early to tell. And I think also when we talk commercial, let's take a step back. That encompasses a lot of different asset classes, right? So we sell multifamily apartment buildings, we sell retail, we sell office, we sell land for development. We've even done industrial, medical. So there's a lot in there. And it is difficult to paint the market with one brush, right? Because there's different things going on in different asset classes, which I know we'll get to today. But all in all, to make a general statement, look, everybody's reading in the headlines, interest rates are up, inflation's up. What does that do to investment sale pricing? And yes, there is pressure on pricing for the simple reason that if it costs more to borrow money and investors are looking for that return, we call it that cash on cash return, then yes, it is going to put downward pressure on pricing, really across the board. Now, how severely that impacts really depends on, which asset class and how long that lease is. So are there shorter term leases, longer term, a lot of factors that go into it. So, but all in all, I think it's still a little early to tell, because when we put out a second quarter report, it's always important to remember that this is really a rear view indicator. And I'm sure it's not too dissimilar to residential. When you look at your residential reports, you're looking at deals that were probably negotiated 90, 120 days ago. It took a while for them to contract. It probably took 60 to 90 days to close and then get reported. So in much the same way, we are waiting to see how this rate increase. So don't forget, in mid-March, we had that 25 basis point increase, and then the Fed increased another 75 bips in June. So if you fast forward 3 to 4 months from each of those dates, what that means is the first rate uptick, we're not going to see kind of the impact of that until next quarter. And the 75 basis point increase, we probably won't see that till the end of the year. So, right now, still a little early to tell, but certainly some downward pressure based on what has just happened.
And if you can,
yeah, go ahead.
I'm sorry, Johnny, go ahead.
No, I was going to say, I was just going to, talk about, there's just this morning, a hot CPI print came out over 9% on the inflation side. And, you mentioned a number of asset classes there, right? You had, multifamily, you had land, and some are obviously more productive than others. And I'm just curious if you could kind of break that down in terms of,
Sure.
Which ones are sort of performing the best.
Right. So real estate in general is a great inflation hedge. It's a hard asset, appreciates over time. And clearly, if you're borrowing money from the bank, and even if it's gone up, so if today it costs, let's say, high 4 or 5% for 5-year money, and inflation is cranking up at 8-9%, you're actually making money on that spread, right? Because you've locked in that rate. So that can be, that can be helpful even with where rates are. But I think when you're talking about at the property level, what you want to do is take advantage. We've talked about the challenges in the market. Let's talk about what's going on the positive side. And you all know too well what's been going on the residential rental side. Rents, if I'm not mistaken, over the last year in Manhattan have gone up by a third. They're actually now above pre-pandemic levels. So if I'm buying an asset class that has, large upside in rents, where we can increase those rents at greater than that 8 or 9% inflation number, then I'm in great shape. I just need to be able to outpace that. Johnny, where we get into challenges is if I'm buying an asset, whether it's a triple net property, which means, the tenant pays for everything, think like CVS, Walgreens. If I'm buying that for a 10-year hold where my income is fixed, right? And I might get some increases along the way, I might not keep up with inflation. So one thing, and this is a little, sophisticated, specific, but it is something, if your listeners are interested in really kind of getting into this space, if you are going to buy, a retail or a commercial property, what we're now seeing, and we are handling some properties that have increases, not only based on a set percentage, but it could be the greater of this percentage or of CPI. So you could actually have an increase in your lease based on what's going on with CPI.
Well, I mean, this is really interesting stuff here. Let me ask you about the office market. And I specifically want to know, maybe there are potential buildings with higher vacancy than others. And I'm just wondering, because we are having this interest rate reset, we are going higher. We are a tech city, we are Wall Street, we're a tech city. Are there buildings that might have some tech, maybe recent startups that are getting a little more negatively impacted by this reset in interest rates? I mean, tech being a long duration asset kind of a thing. What's happening with the office sector, basically?
Yeah, I think that the big question there is the return to office. And if you look at our analysis, we're still, in the ballpark of, upwards of 50, 60% compared to pre-COVID on what the return is to office. And the way we calculate it is we actually use anonymized cell phone data. We actually see who was in the building before and today. And it is very different by sector. And you mentioned tech. Tech has actually been one of the slowest to return back to office or mandate that return to office. I mean, maybe with the exception of, if you want to call Tesla tech, we heard what Elon had to say about getting back into the office. But let's face it, there's a talent war going on right now. And I think for a lot of these companies, if they were to mandate a return to office, certainly 5 days a week, you'd find that a lot of employees would say, well, you know what, I actually like my 2-3 days a week in the office, and to have that flexibility, I'm going to go work for one of the competitors. So I think that is still kind of what's holding back. And some of the question, is if things are starting to get a little more challenging, and I don't want to use the R word, but yes, if suddenly we started to see some layoffs and employers, suddenly there wasn't this huge, job growth, but now employees had to really, prove themselves to retain their jobs, right? You might, certainly see more people showing up to the office, not to mention certainly the benefits of being in the office and the collaboration. But, meanwhile, there's a lot of, if you're doing collaborative work, like, we do here at Avison Young, I mean, I've got everybody out on the floor right now. That's how we work best. So it is different by sector. It's also hugely different by the quality of the building. And what we have seen is that the return to office has been a lot stronger in the Class A and trophy buildings. In fact, employers are now giving their employees a reason to come back to the office. And that's why the One Vanderbilts of the world are fully leased, getting record rental numbers, the Hudson Yards. It's really the Class B, Class C, which is going to have challenges, because right now, we track over 500 million square feet of office, right, in Manhattan. And we're looking at an 18% availability rate. So either currently vacant or for sublet. That's 100 million square feet available. That's a lot of space. And I think this hybrid thing, we've all realized this is, here to stay, right? I mean, so this is kind of the new reality. This is how we're working. So the question is, what do we do with this space, these buildings that are now obsolete? And that is why we are really hoping that there is a way to convert a lot of these buildings to residential. I mean, if you look at it, that's what saved downtown, the financial district. A lot of those office buildings were taken offline and converted to residential. as I mentioned before, there's an affordability crisis. Rents are going through the roof. It would make a lot of sense to convert many of these buildings from office to residential, but that's can be complicated, not only from a zoning standpoint, but an economic standpoint. That might be for a part two.
Yeah, it sounds good. It's just it never happens very quickly. John.
Well, right. And that's kind of where I was going was, talking about the development of these new rentals and new condos. I mean, this is sort of money that's going to be sort of set aside for quite a while I suppose the assemblage is constructed, and then, finally the building gets built. So you're looking at these long timelines, and I'm wondering, what's crossing your desk in terms of either, people looking to sell pieces for assemblage or investors looking to start, cobbling these together. What's that market look like these days?
Right. So if we're talking about new development, right, and specifically residential, because I don't think there's a lot of developers out there speccing, new office, all things considered. But yes, the creation of new residential units, which we desperately need here in New York. There's only about 3 million housing units in New York City. 1 million of those are rent regulated. And based on what happened in 2019, those units will always be regulated. And so you see a lot of the tenants just staying put. So what happens to the rest of the 2 million units? There's incredible pressure because it's a huge supply demand imbalance. So we need more housing. I've heard, tens of thousands of units required. Now, the way that these rental buildings have been built over I've been doing this close to 25 years. And as long as I've been doing this, there's always been a tax abatement program to stimulate rental development. Because if you don't have it, it's very difficult to make the numbers work with the cost of land, the cost of construction as a developer to go through this risk. You're trying to do this to get to a 5 or 6% return. But if you do not have a tax abatement, the real estate taxes in some cases can be up to 1/3 of your rents, right? So unless if you're able to abate that over a period, let the rents grow over time and let the taxes phase in, the developer is saying, hey, we're not going to do this. So unfortunately, the 421A program that we had in place, which was called Affordable New York, which was a great program, it just expired and there's no replacement. There was something proposed up in Albany, but with the midterm elections, we haven't seen anything yet. It could be a while. And so unfortunately, we are not seeing the development of new rental housing. Condos are a different story. If you can find land right now, and a lot of the great land to your question has already been assembled, some of the remaining land, if they're existing properties, they might have regulated tenants in them. And so they are, it's not possible to vacate those buildings and build new. So it's getting more and more challenging to find these places where you can build. But look, and I think you all have reported on that diminishing supply and pipeline of new condos. I think 2 years from now, we're going to be looking around saying, hey, where's all the new condo product? I can tell you just from the amount of land sales, and I'm looking at a report in this last quarter, there was only 10 development sites that sold. I mean, that might sound like a lot, but if you add up all the buildable square footage, those buildings only will total 700,000 feet. It's a drop in the bucket.
I mean,
Right.
I'm trying to digest all this. What would you say is the best opportunity to invest in right now? I mean, you got some challenges on the developer side from policies. You got some challenges on the rental landlord side from policies. Taking into account everything you're seeing and where you predict these shortages and inventory and all this kind of stuff, where is the best opportunity to invest?
So again, if you can find land to build for new condos, I like that a lot because there's clearly still demand, right? And there's going to be a shortage. But look, development is also very risky, right? So if you're an investor looking to make your first buy, or if you're a residential broker, you just sold an overseas investor a $20 million penthouse apartment, and they're saying, great, I'd like to make an investment. Okay. I love retail. And you can either buy freestanding retail, you can buy retail at the base of buildings. And look, retail has taken a huge hit even before COVID. I mean, this was the whole e-commerce effect. We saw, for example, in Soho, that retail rents, today are probably only still 25, 30% of peak. Okay. Are retail rents ever going to go back up to $1,000 a foot on Broadway? Maybe one day, but I can tell you they're not going to stay at 250, 300 a foot. They're going to grow, right? because what's happened is, retailers, when they're looking to sign leases, they're looking at present day. The last year, remember, we lost half of our tourism, right? We used to have 70 million tourists who came to New York in a year. And because of COVID, that got cut in half. So to me, it's very simple, the thesis. Tourists come back, retail rents, suddenly, people are shopping again. And there's all kinds of studies. I think the Wall Street Journal did a study talking about the percentage of e-commerce sales. Well, guess what? It just took a dip, because I think it hit a peak right during COVID. And then people realized, like, hey, I want to go out for the experience. I want to shop in stores. You talk about these digitally native brands who start online. Now they realize they need that physical presence to connect with their customer. They're saying, hey, we need to be in stores, right? And by the way, Amazon's doing it too. They're opening up stores. So their retail is coming back. If you look at the neighborhoods too, the restaurants, you can't even get a reservation. They're doing great business. They've got the sidewalk cafes. I think there is a lot of room for retail rents to still run, and you can get a great return today. You can buy retail right now at a 5-6% return, right? With upside.
Such a great contrarian call. Sorry, Johnny. Such a great contrarian call. And retail was one of the elements of the equation, Johnny, that we said is offline and is down and out, and it's gonna come back, and it's gonna help power this market over time. And let me just add one thing. If you're cash and you're buying that, because finance bids are different, right? You add all these points together, buy retail with cash. Done. So
I just want to throw in there, because I've always loved the idea, and I think it's sort of hit really, it's the sweet spot now. Is that sort of experiential retail. You think, B&H was sort of a forefront where you walk in, it's just like this only in New York kind of experience. I know Wilson built like a flagship store on 3rd Avenue in the 80s, which has a pickleball court in the basement. These are places that people want to go to. And I think this transition has been phenomenal. And the more you talk, James, the more I realize there are an amazing number of parallels between what's happening in the commercial market and what's happening in the residential market. One that you mentioned earlier is the difference between, say, renovated Class A buildings, in which are filled and you're getting great per square foot rents, whereas the Class C, Class B are not doing so well. And we saw the same thing with residential, with the renovated apartments, larger units doing fantastic, unrenovated units needing work. That timeline, those costs were blown out, and they were seeing significant discounts compared to the renovated counterparts. So just to wrap this all up, I'm just curious, if you could sort of, step into both worlds, and I'm just, what are some of the top things in your mind that you think the residential side should know about the commercial side in order to sort of, talk fluently with their customers?
Great. So again, I think that, first of all, you have to know your customer and you have to know what they're looking for, okay? Because investing in commercial real estate, depending on what it is, there's different levels of management intensity. So I would not recommend to your overseas client to go buy a 50, 100 unit apartment building as their first purchase. It is hands-on. And yes, you can get a third-party manager to collect rents and pay your bills, but you still have to asset manage that, okay? It's a very hands-on business. Part of the reason why I recommended retail also is, you might have 2 or 3 tenants. And if you have longer term, if you have those leases in place, you're overseeing it. But again, it's not heavy from a management standpoint. So you really want to ask that question first. How much time can you devote to this? Do you have boots on the ground? We see a lot of these foreign investors, they have local partners, right? And so I think that's really important. I think also you have to, be able to do the work. And, it is to learn the market. It's the same thing. If you told me, James, I'm going to send you a $10 million buyer to go buy an apartment on the Upper West Side, could I try to figure out where they could buy and what to do? But I don't know the pros and cons of each building, right? So I think you want to be, this is still a business in brokerage where we specialize, right? And residential, I'm sure, could even get more specialized where it's, I do resales, I do new construction, I do this neighborhood. Same thing with commercial. So it can get very complicated. Multifamily, we kind of just glossed over it, and the idea of rent regulation, what units are fair market, what's stabilized, what's controlled, what happens when they vacate. These are very complicated rules, regulations. So I just, again, I think there's tremendous opportunity to invest in New York right now. I can tell you, having done this again for a long time, that I am now seeing opportunities that I have not seen for a decade, right? We're seeing returns that are, attractive, right? 5-6% returns. That was never, 10 years ago, we were talking 3-4 caps, right?
Yeah.
And so there are opportunities here, but you really need to make sure that you are, doing your homework. If you are bringing a buyer as a buyer broker, you want to make sure that you're working with a commercial broker who understands kind of what's going on. So you understand the asset and what you're advising your buyer, because you don't want to get them into something where they're in over their head, and you need the right team in place. So that would be, I don't know if that's not one thing I would say, but hopefully that's helpful to your audience.
Yeah, no, this has been fantastic, James. This is you're a rare gem here, James. This has been fantastic. This has been a very educational 20 minutes. I thank you for your time. If there's any brokers out there that just want to, if you learn something from here, find James, send him a thank you. Okay, maybe send him a referral every once in a while. He knows his business. That is James Nelson of Avison Young. That is John Walkup. I am Noah Rosenblatt. This has been Talking Manhattan and Talking Commercial. Thank you so much, James, and we will catch you all next time.
Thank you so much for having me.